Hi, this is Keith Schneider, CEO of MarketGauge.com. This is January 10th edition of Market Outlook, and that is noted 2016. So, not an auspicious start of the year, considering it's one of the first or the worst weekly down closes for the Dow Industrials on record. That has not been overall a positive for the market as a predictor, but not all that conclusive. We are waiting for next week and the finish of what we call the 6-month calendar range for a better indication of what the next 6 months foretell. But meanwhile, markets are under pressure. Let's take a look and get into it right away. First of all, the leading index throughout the world was the NASDAQ 100, and this week it was down a little bit more than the S&P, but more importantly, it actually went and penetrated its 200-day moving average, which is the green line. We've had 3 distribution days, also not a positive sign. We are a bit oversold on the daily charts. As you can see, the very short-term RSI is sitting at 0.5, which is traditionally very, very oversold. And on the 50-day Bollinger Band, also at the very, very lower bounds as well. So pretty important breakdown on good volume. The shorter term, the daily is a bit oversold here in NASDAQ. Let's take a look at some of the weekly charts and then the monthly as well. So interesting, on the weekly chart, the 65 weekly chart, the 65-week moving average was also penetrated. Now, what's interesting is you are in a very strong bullish trend in the NASDAQ 100. You can see your 65-week well above your mega trend, which is the 200-week moving average, and that is well intact. And even on that nasty sell-off last August, we certainly rejected a potential test of that low. So bigger factor is that the overall NASDAQ 100 trend, although weakening by looking at the 65-week moving average as well as the 200-day, have been penetrated with distribution on good volume. So that's where we are. Taking a look at the monthly charts, you can see the monthly chart with the 23-month moving average still well intact. So can't say that the NASDAQ 100 has broken its longer-term uptrend. However, it is pretty narrow. We will get into all the market internals, sentiment, etc. in a moment. Let's go to the spiders because that's what everyone is really more concerned about. Now, what's interesting here in the spiders, you can see that the 65-week moving average clearly starting to flatten out and roll over. This week was a decisive close underneath that 65-week moving average. Not a good sign. But again, the longer-term trend comes in around the 178 level. That is really critical support. Let's take a look at some of the market internals. First of all, sentiment as measured by the ratio chart. This center chart here is our ratio chart of short-term to long-term volatility. As you can see, we are starting to touch the lower bounds of what I would call moderately oversold on a sentiment reading. Look back here in August, you can see that the readings got much, much more extreme on the sell-off. So are we starting to see some signs of exhaustion on the downside? Not quite yet, but at those levels where a turn here above the 1.0 level on the ratio between 1 month and 3 month volatility would generate a buy signal. But meanwhile, the momentum is still down. Now, on this particular chart, what we did here is we converted this to a daily close. Now, what's important to note is going all the way back to the middle part of 2014, 186 level on a closing basis is extremely important in the S&P. So think about it. It's about 3% or so more to the downside, maybe 3.5% before this thing gets really wrung out. If that happens, you would probably see your sentiment indicator down about the 0.9 on this ratio, and that would be extremely oversold, matching what happened back in last August. So again, things are definitely stretched to the downside, but there's still potentially some more to go before you see a bounce, which doesn't mean that the trend, bull trend, is intact. Remember, bear market rallies are some of the sharpest and most extreme, although that doesn't necessarily mean that the bear market is over. So again, look at this here. You can see there's 1, 2, 3, 4, 5 support points going back over a year, year and a half in the S&P. Okay, let's take a look at directly the VXX volatility. This is just volatility by itself. It's often, when it gets outside of its Bollinger Bands, a good contrary indicator once it moves back inside. But meanwhile, as you can see, we've moved smartly above the 50, the 200, and the outer end of the Bollinger Band. So, and additionally, we are at overbought levels as well. So this short-term reading of sentiment on the outside of the bands, definitely suspect every time we get there, with the exception of the massive sell-off in 2008, was generally a good time to do the reverse. So maybe we have another couple of more days of protracted selling here. If so, once this thing moves back inside its Bollinger Band, that would mean that the worst is probably over. But right now, things clearly under pressure. This is definitely what I would consider, until it moves back, a positive sign for volatility to continue to the upside, which is obviously negative for the market. Let's take a look at a couple other charts here regarding the market internals. Okay, the McClellan oscillator, which looks out over several weeks, you can see we're hitting the beginning of what's oversold. The same thing with advanced decline on a shorter term basis, and the same thing on up-down volume. Now, the thing to note is that the advanced decline on the 10-day has not even come close to what the levels were back last August in advanced decline. On the McClellan, which is moving averages of advanced decline data, which is more of an intermediate term type indicator for active traders. And again, that's got plenty more to go. We're only sitting at about minus 194, and we've gotten down to over minus 300 on this McClellan, and so obviously potentially more on the downside. So let's take a look. I've got a new indicator here that I've been playing with, and this one looks at the number of stocks above certain moving averages. So currently, as you can see, this cyan line here is the more volatile one, but it's a very good short-term indicator as well of the strength and or weakness of the market. And at this point, what's interesting, there are only 20 stocks that are above its 10-day moving average in the S&P. That's fairly extreme, although we did get a little bit lower back in late August. So could we get another thrust to the downside, which might be the ultimate blow off before we can see some sort of relief rally? I think we're getting pretty close here, certainly on this indicator. But again, you're looking at potentially, a move down to that 185 to 186 level in the spiders. GLD. Now, what's interesting is we've been talking about this for a bit here. Gold has actually caught some buying on this particular sell-off. We actually are now above the 50-day moving average. So that's looking a bit better. You're in what I would call a weak recovery phase because the moving average is still down. On the longer term charts, weekly, as you can see, the weekly trend still firmly intact on the downside as well. However, a move above 111, 112 would put it above its 65-week moving average and important resistance. So that's an important level to watch. And the gold here is definitely moving counter to the S&P, and its relative strength is looking pretty strong. And we're going to get into that in a moment. I have some new charts that I want to show you. So taking a look at, let's put in gold here. And I'm going to explain some new charts here. Okay. This particular chart is a daily chart. Okay, this is pretty classic. This is a daily chart of gold with the 200-day moving average up over here as the line. Now, what I'm looking at is on this particular chart here is the ratio between gold and the S&P 500 on a daily basis. And as you can see, over the last couple days, we have broken out. Now, what I have here in the middle chart is a chart of the relative performance of the S&P divided by gold and looking at the spread ratio differential. Now, what you can see is that it's traded in a really tight range for several years. And what we are now is gold is hitting the upper part of its range on a spread ratio basis, right? So essentially what this measures is the momentum of the moving average of the spread between gold and the S&P. And as you can see, we're at the upper bounds. So you're getting, this is really a read of the measure of the momentum of the spread ratio, okay? So this is sort of like a hidden element behind the market, which is looking at momentum of relative price movement. And as you can see, we've reached the upper end. If we could break out from here and show additional strength, you could say that the gold market has bottomed out. And you might get this before the market actually moves above its 200-day moving average. The momentum of the ratio might break out first, which is sometimes a really good early indicator. So that's a new way of looking at price momentum. They're looking at the ratio and a moving average of the ratio and seeing where that falls. And as you can see, it's been pretty consistent. All right, so that is one potential bright spot in terms of if you're a general bull market type trader. Gold definitely looking a bit better here, certainly relative to the pressure on the equities markets. Now, let's take a look at one other instrument, which is FXE. And actually, let's do it through a classic chart pattern here. You can see FXE, which is the euro. This is the ETF on the euro that we've been basing out. And again, the euro caught some buyers during this turmoil in the market. So that's interesting to note. Now, we have not taken out the 65-week moving average. Volume was fairly heavy for the week, a little bit heavier than normal, which is interesting. That's a positive. So it caught some buying, had a positive week, and on decent volume, better than average. Let's take a look at the daily charts. That's going to reveal a little bit more. Look what's happening here. I had mentioned this several weeks ago, and then it sort of waffled around as it's forming this base here. But look what's happened here. You now have an inside day, a move above the 50-day moving average. So I would say this is a weak recovery phase. A move, first indication of a move here would be something above 108.50 in the FXE, and that might mean that the bottom in the euro is in place. And so this has been sort of a protracted bear market relative to the US dollar and certainly relative to US equities as well. Now, let's take a look at the spread ratio as well on the FXE. And again, you can see here, on the spread ratio chart on the daily, the euro broke out about a week and a half to 2 weeks ago, which I mentioned. On a ratio basis, you can say that we still have plenty more to go, certainly on a daily basis. And I'll alert you next week if, in fact, on a weekly basis, we break out above this key level that I'm highlighting here, which is about the 1.1 level of the ratio of the moving average of the spread. So that's important to note. Let's take a look at it on a weekly basis as well. Now, interesting, on a weekly basis, we have a completely different type of read here. It looks like on a weekly basis, relative to US equities, the euro has definitely broken out on the weekly chart on the direct ratio basis. However, looking at the moving average of the spread ratio, we have not quite there. We have a bit more work to do, but we're getting close. So definitely looking like the euro is starting to bounce. We have a little bit more work to do. Again, I believe if we can get above that 108.50 level, we probably would have a breakout on all our types of analysis at this point. All right, well, I think you have a pretty good sense overall the markets. Obviously, U.S. Equities definitely under pressure. We are at oversold levels, but they can get more oversold. And the final flush before you can probably expect a rebound, and especially since the market is testing or potentially testing levels at 2-3% under from where it is, where it's already oversold, would really lend itself to a pretty vicious short-term rally to the upside once those levels are touched or breached and flushed out. So that's the assessment at this point. We'll take another look at it next week. Stay frosty because these markets are tricky. Thanks. Have a great weekend and see you next week.